Welcome to this explainer. Imagine a world where the Bank of England completely refuses to blink in the face of rising inflation. Headlines are getting incredibly ugly. The public is growing deeply restless. But the central bank? They just hold their line. No flinching, no softening, and definitely no cutting rates early. Today, we're going to map out exactly what that uncompromising, relentless path would look like for an entire economy.
So, what if the bank never actually blinked? Let's dive right into this alternate reality. In this scenario, your weekly food shop gets noticeably pricier. Rents are staying stubbornly high, and wages, well, they're lagging behind. Everybody expects the central bank to just panic under the pressure, but they don't. Instead, the bank looks right at this inflation fire and essentially says, nope, we are not letting this become a habit. You can literally feel the tension in the air. Because when a central bank stays this tough, the economy stops being a comfortable, easy ride and transforms into an absolute test of endurance.
There's a phrase that goes, its success can feel like pain before it feels like peace. And honestly, that perfectly captures the defining drama of this whole scenario. It really highlights the agonizing trade-offs you have to make when fighting deeply entrenched inflation. It's the brutal reality of monetary policy, right? To stop life from getting permanently more expensive down the road, you kind of have to make life significantly harder right now. And man, that is a phenomenally difficult trade-off to sell to a public that's already exhausted.
To set the baseline for this rigorous endurance test, we have to look at the numbers. The Bank of England has a core mandate to keep inflation low, specifically around a 2% target. But right now, with inflation running hot, they hold the rate at 3.75%, and they're looking ahead to their next major decision in September 2026. This is not a cautious move. It isn't halfway. It's tough. They are forcefully using this 3.75% rate like a massive anchor, basically dragging demand down until the entire economy remembers that runaway prices have some very real, severe consequences.
Now, this macro-level strategy very quickly collides with reality right at the kitchen table, which is ground zero for the household squeeze. Inflation isn't just some abstract economic statistic, you know? It's a visceral, highly emotional social experience. At first, the public reaction would be downright furious. Households with mortgages feel this intense strain way before the macroeconomic data actually catches up. Suddenly, every credit card bill, every loan, and every single big-ticket purchase becomes incredibly hard to justify. What's fascinating here is how a firmer Bank of England instantly splits the country into two totally different but equally valid realities. On one side, picture a family seeing their monthly mortgage payments just skyrocket. They can't move, they feel utterly trapped, and they view this policy as just plain cruel. But on the flip side, imagine a family who remembers what persistent inflation does to their hard-earned savings. For them, they finally see prices cooling off, and they actually feel protected. That right there, that's the sheer agony of a tough central bank.
And that agony translates into this distinct, heavy emotional pressure that completely alters the mood of the whole country. It's like time itself starts to feel expensive. Every single trip to the grocery store turns into a tense negotiation with reality. Every pay rise you fight for at work is immediately canceled out by the rising price of milk, electricity, school meals, train fares, rent, you name it. It just becomes an exhausting daily calculation of the cost of simply existing.
So, the really crucial point to grasp is how this relentless policy creates a ripple effect across the entire country, ending that comfortable economic story we were used to. It happens step by step. Step 1, traders are staring at their screens, mortgages wobble, and it immediately hits those homeowners we just talked about. Step 2, businesses that rely on borrowing have to sit down and do some very sobering calculations about their hiring and expansion plans. And finally, Step 3, politicians brace themselves for the inevitable fallout. For businesses, this tough stance acts as a harsh, almost brutal filter. Higher financing costs are absolutely going to strangle smaller firms that just don't have the wiggle room to absorb the shock. Retailers get super cautious, and big construction projects, they get postponed indefinitely. But at the exact same time, this policy weeds out the companies that were only surviving because money was ultra cheap for so long. It reveals who is truly built to last. That's why hard monetary policy is often described as both destructive and cleansing. It's a ruthless competition between patience and fragility.
All of this leads to an impossible question, one that would immediately dominate TV panels and pub conversations across the country. Is the bank protecting the value of our money, or are they just crushing economic growth? Are they heroically fighting inflation or punishing everyday folks for a problem they didn't even create? Every single speech from the bank would be analyzed like a battlefield map to see if the so-called cure is actually becoming the illness.
But hey, let's look out at the horizon for a second. If this incredibly difficult adjustment actually succeeds, the massive long-term payoff is predictability. Inflation expectations decisively drop. Wage bargaining goes back to normal. Real incomes recover cleanly because, well, prices have finally stopped running away from us. We often think we want fast economic growth above all else, but in reality, what families and businesses usually need most is just a stable, predictable environment, a place where they can actually plan for the future without the ground constantly shifting beneath their feet.
And this brilliantly triggers a rather strange cultural shift. Basically, economic discipline comes back into fashion, the return of frugality. When easy money dries up, being frugal isn't just necessary anymore, it becomes culturally relevant again. Suddenly, everyone is actively comparing notes on savings accounts, fixed-rate mortgages, and just general household resilience. Businesses get way more selective with their projects, and workers start demanding wage growth that genuinely outpaces the true cost of living. Plus, when the band-aid of easy money is completely ripped off, a tough central bank indirectly forces the whole nation to stop looking at just the symptoms. We finally have to seriously examine our hidden structural weaknesses. We're talking about honest conversations regarding housing constraints, wild energy costs, chronic labor shortages, and weak productivity. Not to mention supply disruptions, imported inflation, and fiscal choices. Obviously, monetary tightening alone can't fix these things, but it for sure forces politicians and the public to put them under much sharper scrutiny.
We definitely need to look at the darkest version of this scenario, though. What if the bank stays tough for a little too long? There is a massive risk of overconfidence here. A prolonged, unyielding hard line could tightly compress the entire economy and breed some deep public resentment. People might start to think that the bank cares way more about some abstract economic theory of price stability than about the very real suffering of everyday households. And let me tell you, when an institution loses public trust, the environment becomes incredibly toxic.
If the central bank pushes this delicate balance right to the absolute edge, it risks turning the economy into a permanent stress test. Just look at the timeline. In month 1, consumer confidence severely weakens. By month 6, borrowing and hiring grind to a painfully slow crawl as recessionary conditions take hold. And by month 12, pockets of unemployment visibly rise. This is the exact moment where the public conversation shifts emotionally from "why are prices so high" to "why is everything so terribly hard?" This creates one of the most politically dangerous gaps in modern economics. On one hand, you have the financial markets. Bond yields shift, equity markets adjust, and investors actually respect the bank's toughness because it signals a deep commitment to long-term stability. But on the other hand, everyday households are living through the agonizing daily reality of this adjustment. So the markets applaud the discipline while the public just endures the pain. Navigating that gap, it's an incredible high-wire act. Ultimately, the bank's core message boils down to this powerful idea. They are protecting the economic future from becoming hostage to the present. They are defending the idea that tomorrow should not be systematically worse than today just because prices got out of control. It's really not about being cruel. They are essentially asking the country to accept discomfort today so that the next chapter of our lives isn't written in exponentially more expensive ink.
As we wrap up this explainer, I want to leave you with a pivotal question to chew on. When an economy is truly on the brink, what matters more? Is it unwavering toughness to kill inflation, or extreme caution to protect everyday growth? It is the ultimate test of economic endurance. I'd love to hear your thoughts on how a modern economy should balance this high-stakes tightrope. Because at the end of the day, the hidden machinery keeping our economy stable affects absolutely every single part of our daily lives.